Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, even though there's a debt deal, it still seems to be all about the economy as far as the market is concerned and investors. We're going to talk about all of that this edition of the Roundtable with our editor-at-large, Steve Reitmeister, research director Shiraz Mian, and market technician Kevin Matris. So, Steve, as of this recording anyway, there's a deal supposedly that everyone can live with, but no vote yet as we sit here and speak. So we don't know if there's a real deal or not.
Yeah, and most likely it will be passed. And you're right, it's a deal that everyone can live with, but no one likes. You know, it's one of those kind of things, and it's pretty watered down and what have you. So, you know, the best that can be said about it is that it keeps the checks flowing, that we do not have this day of Armageddon that was completely overdone, you know, in the media. But it does start to get us to focus back on the economy a little bit, which has some positives and some negatives out there, and so you know, it'd be nice to get this debt thing off the table so we can concentrate on the real drivers of the market.
Right. Yeah, one thing it doesn't do is the deal does not fix the economy, Shiraz. Relief rally, we saw a little bit of one until the ISM numbers came out this morning, Monday morning. Might there be another part to this relief rally going forward, or was that at 30 minutes?
That's enough of a relief, Terry. Don't ask for more. So you just removed this big threat, this big cloud that was hanging over the market over the past month, and that in itself is a positive for the market. So less of a negative, or the end of a negative, is a positive. But you raise a good point. Now that this issue is beyond the radar, we focus on the things that actually matter, and the things at that front are quite ugly. On Friday, we found that the economy that we all along knew was soft was actually quite horribly ugly. The Q1 numbers were revised down literally to the bone. The last year's Q4, which we thought was pretty good, even that was revised down.
Yep.
So once the attention focuses to the actual numbers, the economy's growth momentum, there's plenty of stuff to be worried about and concerned about, and that probably will put brakes on whatever relief really we got this morning.
Yeah. So, Kevin, the scenario here as far as the economy is concerned seems to be what Steve's been talking about here right along: slow growth, high unemployment, and blah, blah, blah.
Thank you, Steve.
Yeah.
Now it's going to be more of the same. The debt deal crisis, which seems to be over, we're not going to have a technical default, doesn't really do anything to address the long-term problem.
Yeah.
Now we get a chance to look at the real problem, and that is the horrible growth rate. My big concern is that everybody was expecting the second half of 2011 to be fantastic.
Right.
Where are we going to get these good numbers? I am very concerned for Q3 and Q4 of 2011.
Despite what may turn out to be solid earnings in both of those quarters?
Well, I mean, we're seeing good earnings right now, but if analysts are going to have to revise down their GDP estimates, that is going to come from somewhere, and that is probably going to come from corporate profits. So earnings should, in my opinion, probably be less auspicious than what people are expecting right now.
Let me talk about this.
Okay.
Will there be a revision of corporate earnings going back the last several quarters?
No.
Right. Okay, meaning that's reality. Okay?
Right.
And now we have to mark that reality versus this new reality of what the GDP is. Now, this idea that the normal GDP growth rate is around 2.7%, or people just kind of round it off and say 3%, that is not the reality going forward. In fact, a lot of that past supposed reality was from people refinancing their mortgages, which was good for upwards of 0.5 to 0.75% of GDP. So therefore, if you remove that, okay, as an artificial stimulus to the economy, then the attractive growth rate of the economy is around 2%. Okay. The fact is that corporate earnings have much more to do with stock prices than GDP. In particular, when 40% plus of U.S. corporate earnings come from abroad. So therefore, we can have muddle-through growth, 1% to 2% growth, okay, in our economy, and still have earnings growing. And then most importantly, versus alternatives, versus keeping your money in cash, which pays nothing, stocks are still the most attractive thing. So I'm not saying that GDP of plus 1.3 is good. You have to take a look at the alternatives. Right. You got to take a look at it versus the backdrop of reality. And so in that light, I'm still long stocks.
Some good points made there.
The best case scenario is what Steve put together. That is that the economy could grow at under 2%, and the corporate sector could still generate solid earnings. But if you have the economic outlook coming down for the second half and into 2012, can a question reasonably be raised that the earnings expectations may be a little bit on the loftier side? And the market, at the end of the day, reflects these expectations on the margin. So if expectations for the second half for 2012 start coming down, that may start weighing on stock prices in the coming days. So yes, the economy could grow at under 2%, and we could have solid earnings, but it could be less solid, if there's such a word.
And that's my fear.
Than they were in the past.
Right. My fear is that we're going to grow below 2% as opposed to the expectation of growing above 2%. So yeah, the U.S. is still probably the best game in town. But yes, I do believe that expectations will probably be ratcheted lower to accommodate this new reality.
Then there's that wild card of interest rates that we haven't even talked about yet.
Right.
A lot of people are expecting a downgrade in the U.S., even if a deal is reached. Will that downgrade bring a hike up in interest rates, or an upward turn in interest rates at least?
From the historic lows that we are now, and a lot of people think that maybe it would be 25 basis points, so a quarter point, maybe a half a point on that raise is a sneeze in the grand scheme of where we are at on how low interest rates are. And if people were worried about that at all, I think everyone knows that S&P have panned themselves into a corner where they have to lower the rating of U.S. debt, and yet what happens with the rates? They're going lower and lower and lower. So, so I'm saying worst case scenario is it goes up a little bit, which would not really horribly affect anything given where rates are right now. But I tell you that the bond investors are not blinking. Okay. They're perfectly fine.
I just wanted to throw that out there.
Yeah, I hate to be so cynical. I'm always so bullish, but my big fear now is if rates do go up, even if it's just incrementally, I'm worried about the dollar going up, and that is going to shave off earnings that companies are getting from overseas, which will once again reduce earnings. So
I was kind of alluding to that, but I didn't want to be the wet blanket.
Yeah, I'll be the wet blanket today.
All right, give us your top stock pick while you're there.
Mine is NCR. They are in the computer and integrated systems industry. They do a lot of stuff that most people, use every day but probably don't even know. They're a big manufacturer of ATM machines. They do a lot of grocery store terminals, sales terminals. They also do the kiosks for Blockbuster's rental machines. Either way, they have a fantastic growth rate. Their valuations are well below the industry median. They just broke out of a nice consolidation pattern. I'm looking for a $25 price target for a 25% increase from here, regardless of what the economy does.
All right, Shiraz.
Chipotle Mexican Grill, an excellent growth story within the restaurant space. They're primarily in the U.S. They have drawn out a long-term expansion plan globally as well as domestically. They're going to be opening up 100+ stores every year. They are expanding into new concept restaurants as well. So overall, an excellent growth story, which both on comps as well as unit sales stands out in the industry.
Okay, Steve.
Last time he did Chipotle, he came out with all these great metaphors. It's a spicy stock, so he tamed it down this time. But I was looking forward to some of his.
Thanks for using the spicy.
Yeah, I had to throw that in because he didn't. I'm going with Cummins, which is known for their engines that go into buses, trucks, large boats, etc. The more the world economy expands, especially in emerging markets, the more they have to move people and goods and services, not services, moving goods around. Right. And their growth has been phenomenal, just coming off another great earnings surprise. with earnings moving up to about $10.50 per share out into next year. A lot of people calling for $130 to $150 per share.
Wow.
So with the trading under 110, quite attractive at this time.
All right, well that does it for this installment, but it doesn't stop the commentary at this point, because if you are not watching this video from Zacks.com's homepage, if you're outside of the homepage, you'll want to go to Zacks.com, especially with debt deal commentary and economic commentary and market commentary being in a state of constant flux. That's where you'll get the latest commentary, thoughts from these gentlemen and some others who write for Zacks.com. With everyone here, I'm Terry Ruffalo.